When you started to invest in the market, I know people said, read this book, read this book. I'm sick and tired of everyone recommending the same damn book all the time.
मेरा बेटा इन्वेस्टर बनेगा.
We at LearnApp always try to bring something simple for you and something different. And this time, we have this series of books that we are going to summarize for you in this video. It's called the Little Book Big Profit series. It's a series of 29 books, about 250 pages each. And I've selected 3 books today, and we'll go through each one of them so you don't have to read 250 pages. But before we begin, I need you to do something right now. Comment in the video saying that I want to learn investing and transform my life. I think this is a life skill and all of us should learn to invest. The first book I have over here is called The Little Book That Builds Wealth. What do you look while investing in a company? It could be a great product, great management, or even great scale of the business. But surprisingly, this book doesn't talk about any of this. It talks about structural competitive advantage. So let's understand the 4 things the book talks about. The first is intangible assets. This means that the business has such a good brand, it can charge more than what it costs and do this for a really, really long time. Think about all those crazy looking shoes and bags versus what you see in your local shops. These guys are really expensive because they have a brand. Another example is Coca-Cola. They charge a lot for sugar water. The second is the customer switching cost, which means once a customer becomes a user of that product, it's very difficult for him to switch to another product. For example, people eating Maggi versus Patanjali noodles. So even if there's a better product out there, the switching cost is just too high. This is also a great advantage for a business to have if it can crack this. The next is network effect, and I love this. Basically, with more usage of the product itself becomes better. Think about LinkedIn. Every time you create a profile, send a friend request, the network is getting stronger. Facebook, same thing. Instagram, same thing. Every time you upload a photo, the app becomes better. Another example is, say, LearnApp, which is this great financial education platform you should check out, where more people use it, they comment, they help each other, and the network effect just improves the product by itself. Jokes aside, what I'm trying to say is products which have a network effect grow in order of magnitude versus just a service. If you have any questions around this, post it in the comments and we can run up a discussion. The fourth is cost advantage. Now, there are 2 ways of making a profit, right? One is you increase your selling price, and the second is that your costs are lower than your competitors. Usually what businesses do is they have backward integration. So if they produce their own raw material, because it's cheaper, they're able to have higher margins. So take an example of Tesla. If Tesla produced its own batteries, and I think last time I checked, they were building a gigantic, enormous factory just to do that, then they'll be able to sell their Tesla vehicles cheaper because they produced the batteries. So what's the learning outcome here? You're basically learning how to detect a moat in the business. So here's what I would recommend. First, figure out how to build a portfolio. For example, if you learn Trend Investing by Atul Suri on LearnApp, he will give you quantitative ways, step by step, to create a portfolio which manages risks and has an exit strategy as well. Now, once you've come up with that list according to the strategy, you can apply the structural competitive advantages in this book and make sure that your list makes sense. The next book we have is called The Little Book of Trading by Michael Covell. If you've not heard of him, this guy has been talking about trend trading for ages. Trend trading is basically only looking at price and following institutional money over a long period of time. So Michael Covell has actually brought down life lessons of 10 trend traders in this book. And voila, one of those people is Tom Basso. Tom Basso has actually taught a trend trading strategy on LearnApp, which is made up of 4 steps to actually enter and exit stocks in India. There are two things about a trend following mechanism you need to understand. One, you need to have a stop loss. And second, you need to stay with the trend. But let me show you this with an actual example, a quantitative example. So in the book, the author talks about the Russell 3000 stocks. Think about Nifty 50, but with 3000 stocks abroad. If you followed the Russell 3000, you would have earned 8% annually from 1991 to 2008. However, if you had kept a stop loss on these stocks, then you would have actually earned 26% and not 8%. So having a stop loss in a trend following method really matters. And this has been calculated by looking at missing the worst 25% stocks in Russell 3000. The second thing is even more interesting. If you look lower here, if you miss the top 5% companies in Russell 3000, your returns would not have even been 8%. It would have been -1%. That means a small number of stocks contributed most of the returns. So staying with the trend is also super important. This is very interesting to actually see. If you read this book, it's filled with these small nuggets, and one of them is this by Larry Hite. If you don't bet, you don't win, and if you lose all your chips, you can't bet. It's basically a quote on risk management. The third book is on psychology. So we talked about investing first, then we talked about trading. Now let's look at psychology. It's called The Little Book of Market Myths by Ken Fisher. This 162-page book will make you never sell your long-term investments. And I'm not at all surprised that the author of the book is Ken Fisher. That's the son of billionaire Philip Fisher, the original long-term investor. One thing I'll never forget about Philip Fisher is that he invested in Motorola in 1955 and he held it until his death in 2004. That's like 50 years and a CAGR of 20%. But the point is that you should hold on to your stocks for as long as possible because even great companies need a lot of time to compound and make wealth for you. Also, the author manages $180 billion US. I need someone to comment right now and tell me how much that is in rupees, because that's a lot of money. So you should take this guy a little seriously. This guy has detailed some 17 myths, and some of them are really shocking. I'm going to talk about a few of them only. The first one is that bonds are safer than stocks. And he's explained this phenomena in the book. The only thing over here is that equity versus bonds is explained over short-term and long-term. So look at this. You'll see here that over a 5-year period, equity 100% returns gives you a 9.9% annual return and a standard deviation of 8.8. Think of standard deviation as volatility. If you don't know what that is, basically higher the standard deviation, higher the risk, okay? So you want a lower number. Then let's look at bonds. Bonds has a 5.5% return and a less volatile movement, less standard deviation of 4%. Fair enough, but now let's fast forward and change the time from 5 years to 30 years and see what happens. Now equity, the return is increased to 11.2 and the volatility part, the standard deviation part is 1.4. It's almost not there at all. However, bonds is still 5.5%, 5.3% and the standard deviation is 2.8. You see what that means? That means that over long periods of time, stocks are technically safer than bonds. It's just about your mindset and the time frame you're looking at. The second myth is that stocks don't do well when there is a war. Actually, whenever there is a bad event, we tend to think it's bad for stocks. This is not true, guys. And let's prove this by looking at this chart here. Let's see some more recent events, actually. You can see North Korea tests nuclear weapons. This can't be good for the market, right? But it was up 20%. The global crisis hit in 2008. We were down 40%. Then unemployment rate exceeded 10% in 2009, but the market was up 30%. The point the author is making is very simple. Don't try to connect news with the market. We've also seen during this lockdown period when markets are doing so well, don't try to bring logic of news and what the market is going to do. If you're an investor, follow an investing strategy. We have a bunch of them here, but basically follow a set of rules. Don't look at news. And if you're a trader, simply look at price. That's all that matters. If the market is in an uptrend, follow that trend, again, using a systematic method. The point here is don't look at the news. So there are two conclusions to this book. The first one is that news is designed to create panic in form of sensationalizing any piece of event. So if you look at the news, you'll find something is wrong somewhere in the world all the time. So stay away from that. The second conclusion is that even if there is a bad event, if the company has high quality earnings and a good moat, it won't affect that company for a very long period of time. It will bounce back and continue its trajectory upwards. I hope you found this video interesting. The good thing about these books is that they use data to prove a point, which is always welcome in my case. So if you're interested to become super serious about trading or investing, click on the link in the description and you will get 2 months extra when you sign up for LearnApp. We have an entire map starting from basics to fundamental analysis and even teaching you step-by-step strategies. You should definitely check that out. And if you have any questions, we have a huge audience of people helping you every step of the way. We're also trying really hard to make great YouTube videos that can explain a lot of things in a short period of time. So check out this video we made recently and this one too. And don't forget to hit that subscribe button and hit the bell icon so every time we release a video, you get to know something's up at LearnApp. See you in the next video.